Okay, picture this.
Hmm.
It's the middle of the night, really quiet. Then bang, your phone rings. And it's one of those calls. An emergency, something needing money like right away. Have you ever really stopped to think, are you actually prepared for that? Life just doesn't send out warnings, does it?
No, it really doesn't. And being caught off guard financially like that,
Yeah.
well, it can be incredibly destabilizing.
Exactly.
And what's interesting, I think, is how much we focus on, say, investments, growing wealth, tax planning, all crucial stuff.
Right.
But sometimes we overlook this really fundamental layer, liquidity. And that's what this deep dive is all about, isn't it? That bedrock. The emergency fund, and, the thinking behind having cash ready.
Okay, so let's really nail down what we mean by liquidity. Basically, it's having funds you can get to quickly.
Right. Quickly and without losing value. Think about it if most of your money is tied up in, say, real estate.
Yeah, like a house.
Exactly. And suddenly you have a big medical bill, selling property. That's not fast.
No, definitely not overnight. And that delay, wow, that just adds so much stress when things are already tough.
It really does. And if you look at the bigger picture, liquidity is, well, it's like the lifeblood for your finances.
The oxygen, maybe?
Yeah, good analogy. Financial oxygen, ignoring it is like walking a tightrope without a net. It's risky.
It is. Which brings us straight to the emergency fund itself. It's not really optional, is it? It feels more like a responsibility.
I completely agree. It's your financial first aid kit, your buffer against all those curveballs life throws, losing a job, a health scare, business trouble, family crisis.
All the unexpected stuff.
Precisely. And its main job is simple. Cover your essential living costs if your income just stops. We're talking rent, groceries, loan payments, school fees, utilities.
The basics.
For how long, typically?
The general advice is for 6 to 12 months.
Okay, 6 to 12 months of essentials. So how do you figure out that number for yourself? Right. That's the key question for you listening. You start by figuring out your average monthly essential spending. What do you absolutely need?
Got it.
Once you have that number, the rule of thumb is multiply it by 6 or maybe up to 12. So let's say your non-negotiables add up to $30,000 a month.
Okay.
Then your target emergency fund is somewhere between $180,000 and $360,000. And look, it's not just about the money itself, it's about the peace of mind that gives you.
That makes sense. It's freedom, in a way. So this is really practical then. In this deep dive, we're going to give you a clear path, right? Step by step on how to build this fund and, importantly, how to manage it.
Exactly.
Because it's more than just finance, isn't it? It's about feeling secure, self-reliant. Imagine losing a job, but having that breathing room to find the right next step, not just grabbing anything out of panic.
That's a huge benefit. And what strikes me is that building this fund isn't about one big effort. It's consistent habit.
Like a marathon, not a sprint.
Yeah, precisely. So step 1 is setting that clear goal. Knowing the target amount based on your own expenses makes it real, tangible.
Right. And crucial point, keep it separate. Open a dedicated account just for the emergency fund.
Yes. That stops you from accidentally dipping into it for everyday things or non-emergencies. It's like putting a fence around it.
A financial sanctuary, I like that.
Yeah. And then consistency. Absolutely vital, just like maybe a SIP for investing. Set up a regular monthly transfer to this emergency account. Even small amounts add up.
Keep chipping away at it.
Exactly.
And here's a little pro tip. Get a bonus. Or some other extra cash comes in, shovel a chunk of that straight into the emergency fund. It's a great way to fast track reaching your goal.
Good idea.
But maybe the most important rule, discipline. Pure discipline.
Yeah.
This money is only for genuine, unexpected crises, period.
That's the golden rule. Now let's shift gears slightly. Think about the impact beyond just the bank balance. There's a really powerful link between having this liquid safety net and, well, your mental peace.
Oh, absolutely. Knowing that cushion is there, it just lowers the background hum of anxiety, doesn't it?
It really does. It acts like, I don't know, an insurance policy for your mental well-being, less stress about potential financial shocks.
Yeah, and that security actually helps you make better long-term decisions too, right? Like with investments, you're not thinking, oh God, what if I need to sell this low because something happened?
Exactly. You're not making decisions from a place of fear. And it reinforces that sense of being in control, of being self-sufficient, responsible for yourself and your family.
Okay, so we've talked about why it's essential and the basics of how to start building it. Now, a really practical question for you listening. Where do you actually put this money?
Right. Where do you park it so it's safe, but also super accessible when you actually need it? Because remember, the number one rule here is liquidity. getting your hands on it fast without losing any money.
Okay. So the obvious first thought for most people is probably just a standard savings account.
Yep, most familiar.
The pros are clear. Super liquid, right? ATMs, UPI, instant access, basically zero risk. Available 24/7.
True.
But the downside is the interest rate. Usually pretty low, like 2.5% to 4%. Your money isn't really growing much, especially with inflation.
It's definitely not keeping pace.
So our take, keep some there. Enough for immediate needs, maybe what you'd need the next, say, week or two.
Makes sense for that very short-term buffer. Another common option is the fixed deposit, the FD.
Right, the FD. Generally gives you better interest, maybe in the 6% to 7% range.
Yeah.
And it feels secure. Plus, you have that deposit insurance up to 5 lakh.
Definitely secure. The slight catch, though, is liquidity isn't quite as instant. Breaking an FD early often means a penalty or you lose some interest.
And you might be stuck if you need it outside banking hours, unless you plan ahead.
Exactly. Unless you specifically look for those flexible FDs, the ones with an auto break feature or an overdraft link, those can make access easier in a pinch.
So worth checking the fine print on those. Okay, what about something potentially offering a bit more return but still fairly liquid?
That brings us to liquid mutual funds. These invest in very short-term, generally safe things like government securities or top-rated company debt.
Okay.
The upside, potentially better returns, maybe in that 5.5% to 7.5% range, generally higher than savings accounts, sometimes beating FDs. And usually you get your money back within one business day, T+1 they call it.
So pretty quick. And tax-wise.
If you manage it carefully, especially if you hold for a bit, the tax can be efficient. The main thing to remember is there is a tiny bit of market risk, though it's very low for good liquid funds. And it does take that one day typically.
So not quite instant like a savings account, but close.
Right. Our suggestion here, if you go this route, look for schemes with high credit quality, like an A rating, and maybe check their track record for the last year or two.
Good advice. Are there any other options? Maybe for really tiny amounts?
Well, for truly instant, maybe super immediate needs, you could keep a very small percentage, maybe less than 5%, in something like digital gold or a payment bank account or even just a UPI wallet balance.
But just a tiny slice.
Yeah, they offer instant transactions, but they aren't really the best or most secure place for the bulk of your emergency fund long term.
Okay, that gives us a few options. Savings, FGs, liquid funds, and a sliver elsewhere maybe. So how should you actually split the money between them? Probably not all in one place.
No, diversification makes sense here too. Spreading it across maybe 2 or 3 options gives you a good balance. Some instant access, some stability, maybe slightly better returns on another part.
So what's a reasonable split as a guideline?
One possible strategy, and this is just a guideline, could be something like maybe 30% in your savings account for those immediate within a few days needs.
Okay. 30% savings.
Then perhaps 40% in liquid funds gets you potentially better returns, but still quick withdrawal, that T+1 access.
Right, 40% liquid funds.
And the remaining 30% in a flexible or breakable FD for that rock-solid stability and slightly better interest than savings.
So 30 savings, 40 liquid funds, 30 FD. That sounds like a balanced approach.
It aims for that balance, yes. But remember, setting it up is just the start. You have to maintain it too.
Good point. It's not set and forget.
Definitely not. Make it a habit at least once a year. Review your essential monthly costs. Have they gone up? Inflation, lifestyle changes.
Rent increase, school fees went up.
Exactly. If your expenses rise, you need to adjust your emergency fund target upwards too to maintain that 6-12-month cushion.
Right. Keep it relevant to your current life. And what if you actually have to use some of it?
This is critical. If you dip into it for a genuine emergency, and only a genuine one making it whole again needs to become your absolute #1 financial priority.
Pay yourself back first, essentially.
Yes. Before anything else non-essential, remember, this fund is your security, not an investment pot to chase profits or something to read for impulse buys.
Got it. Security first. So let's try and pull this all together into a really clear action plan for you listening. Something concrete.
Okay, let's do it. Step 1, analyze your expenses. Really dig into what's essential each month. Your EMI, rent, groceries, school fees, insurance, basic utilities. Get that number.
Let's use an example. Say your absolute must-pays total $35,000 a month.
Okay. Step 2, set your target. Aim for 6 to 12 months of those expenses. So with $35,000 a month,
that's 2.1 lakh on the low end up to 4.2 lakh on the high end. That's your goal range.
Exactly. Step 3, start contributing. Decide on a fixed amount or percentage, say 10% of your income each month, and set up an automatic transfer. Treat it like a bill you have to pay.
Like that SIP analogy again. Make it automatic.
Yes. Step 4, divide the funds you accumulate. Use that suggested split or adjust it slightly for your comfort level, maybe that 30% savings, 40% liquid funds, 30% flexible FD.
Allocate strategically.
Right. And finally, step 5, review annually. Check your expenses, adjust the target if needed, and crucially, if you used any funds, replenish them ASAP.
Perfect. Analyze, target, contribute, divide, review. That's a solid plan.
It gives you a clear roadmap.
Thinking about this whole thing, it's really more than just the money, isn't it? It's about the mindset it creates.
Absolutely. Having that emergency fund isn't just about the rupees, it's about the feeling of security it builds. Confidence about your job, your health, your family's well-being. It's like a mental anchor.
Yeah, an anchor in potentially stormy seas. That's a good way to put it.
And that security has knock-on effects, It reduces financial stress, which is huge. It helps you make calmer, more rational investment decisions because you're not worried about needing cash tomorrow.
Right, you're not reacting out of fear.
Exactly. It makes planning for the future easier, kids' education, retirement, whatever. And, interestingly, it can even put you in a position to help others if they face a crisis.
That's a nice thought, too. Building community resilience.
It really enables that shift, doesn't it? From just surviving financially to feeling stable, empowered.
Definitely. But people do make mistakes with this, right?
Right.
What are the common pitfalls we should warn against?
Oh, definitely. A big one is chasing high returns with all your money, forgetting about liquidity entirely, investing everything, leaving nothing easily accessible.
Yeah, putting everything in assets that are hard to sell quickly. What else?
Using the emergency fund for things that aren't emergencies. That big sale online, a last-minute vacation, that's not what it's for.
Resisting temptation.
Exactly. Another mistake is the opposite of the first one, keeping the entire fund just sitting in a basic savings account. You miss out on potentially better, yet still safe, returns from FDs or liquid funds.
Leaving money on the table, essentially, without much added safety benefit.
Right. And maybe the biggest mistake of all, just not starting, procrastinating, thinking, I'll do it later.
Later often becomes never.
Sadly, yes.
Okay, so you've listened to this deep dive. You understand why this fund is so important. But honestly, knowing isn't enough, is it?
Not at all. Action is everything here. We really want to encourage you listening. Take that first step. Start building your fund now. Don't wait.
Even small steps count. Consistency is key. It really does build up over time into significant security.
Absolutely. So just to wrap up the core message, an emergency fund is it's a vital tool. It's your financial shock absorber. It brings peace of mind, resilience.
Think of it like a loyal friend, maybe. Always there for you in a real crisis.
Yeah.
But you have to, make the effort to build that friendship first.
Well put. Which leads us to a final thought for you to chew on. We live in pretty uncertain times, right? The world feels increasingly volatile.
True.
In that context, maybe your preparedness, your financial readiness is actually your greatest asset. So how will building the safety net truly empower you to face the future with more confidence? For yourself, for your family?
Something to really consider. So the message is clear. Take that first step. Start today. Build that foundation for your financial preparedness.